Okay, folks, welcome to Best Stock Charts for the coming week. This is Bob Desmond at the Contrarian Trader, and these are the stocks that we'll be looking to trade in the coming week. Now, members, what we're going to do tomorrow, being Sunday, is we are going to go over these stocks in greater detail. We'll do a deep dive into not just the higher level view, the weekly and daily charts as well, but on this commentary, I'm just going to go over the weekly charts. So if you're not currently a member, given the market environment, you need to ask yourself a question. Today being Saturday, maybe you're watching this on Sunday, ask yourself the question, do I have a strategy moving into the new trading week? Do I feel comfortable with my positions? And am I hoping when I should fear? Now, if your strategy has anything to do with Jay Powell coming out yesterday and still talking up the economy, that's a bad strategy, because for all intents and purposes, what he said is don't expect too many rate hikes this year. So while he was talking hawkish about the economy, when you read between the lines, he was quite dovish, especially when it came down to productivity here in the United States and globally. So tomorrow, what we're going to do is we're going to sit back. We're going to discuss with members the overview of the market. Remember that 85% of all stocks will trade with their parent index. So we'll do a review of the major averages. Then from there, once we form our conclusion as to where we believe this market is heading, then we will do a deeper dive into the stocks I'm going to go over right now. So if there are three charts that I would say you need to watch out for, two stand out the most for me this weekend, because we have U.S. carrier battle groups moving into the South China Sea, raising escalations of a trade war, and quite possibly a hot war over the Spratly Islands. Nobody likes those islands being there, with the exception of the Red Chinese. Now, as the trade war escalates, you may be asking, does the trade war play into your trade theory at all? Absolutely. No doubt about it. Because remember, it's U.S. industry that has suffered at the hands of the Chinese. And don't get me wrong, I'm not blaming the Chinese. They did what they should do. They robbed our businesses. They stole our jobs. But only because our politicians allowed them to. And this is not a Democrat-Republican thing. They are all guilty. So one of my main concerns here that could affect the U.S. consumer, the U.S. economy. My main concern is the fact that the Chinese, as I mentioned before, we have financed the building of Beijing, their major first world cities, whereas we've allowed our infrastructure to decay. So one of my concerns about what the Chinese could do to us here in the United States with regard to this trade war, we need to keep in mind that the Chinese are our banker, along with the Japanese and to a lesser extent the Europeans. They have financed a ridiculous lifestyle that the U.S. consumer has been living on for the past 20-odd years. For all intents and purposes, we have been living on a credit card and only paying the minimum amount due on a zero interest rate promotional rate. But those rates are heading higher. So what concerns me about the Chinese and what they could do here in the United States? Well, they could devalue the yuan. They did that back in August of 2015. What did the dollar do that month? It went down. I'm not as concerned about that. What I'm concerned about more are the Chinese, and this is the nuclear option, the Chinese selling our bonds. And you can see by this chart here of the 10-year yield that last week, initially we were, as of Thursday market open, we were breaking out on the week. And as I always like to say, it's not 3:59 Eastern Standard Time, Friday afternoon, so anything could happen by the close of the week. And sure enough, we gave up a dramatic amount of the week's gains on the 10-year yield. So you had money rotating into the bond market out of fear for what was going on in the stock market. Now, if the Chinese decided, well, you know what, we don't want to buy your debt, we don't want to continue to promote your lifestyle, which is just absolutely ridiculous, you're going to see the 10-year yield rip through 3% in a heartbeat. Now remember, it only took a yield of 2.94% only a couple of months ago to cause the stock market to buckle. So what's my main concern? The Chinese start dumping treasuries, or at the very least, they stop buying. So how do we know when the U.S. economy is in a world of hurt? Two things. One, as I just mentioned, yields are rallying. That means bonds are falling. Two, the U.S. dollar, which has been rallying off of its lows of late these past several weeks, it did break out last week, but failed. It closed off the highs of the week because of the jobs numbers. If you see bonds drop along with the U.S. dollar, it is all over for this economy for quite some time until we can restructure our debts. And that will be no easy task. Remember, we are $21 trillion in debt. And if we break, this is the UUP, if we break 2308 on the UUP and close there on a weekly basis, we're going a lot lower. So that leads us into, what am I looking at for the next week and weeks in order to profit off of what appears to be a major breakdown in the US dollar? It's not going to be Google. It's not going to be Facebook. It's not going to be Amazon. We'll be looking at gold. I've been talking about gold for months now. And you may be saying, yeah, you're right. You have been speaking about gold for months now, but it hasn't done all that much. Well, I'll tell you one thing. Relative to the S&P 500, which is down on the year, gold is up. And we are breaking out. Ignore the breakout at your own risk. We're breaking out on a yearly chart. We are breaking out on a quarterly chart. We broke out several quarters ago. Here, January of 16, we pulled back, retested the breakout point. Now we're moving higher yet again. Admittedly, we are hitting resistance. 1377.50. You see it close above that level. We're going to be at 1400 on gold in a heartbeat. So we're watching gold. Members, more to come here. And we are already positioned long of the gold mining names. What else are we looking for, especially if we see a drop in the US dollar? Emerging markets. Weekly chart. We are in a triangle formation. Granted, RSI is weak, Stokes are weak. Would I go buying the emerging markets on Monday morning? No. But I have to be honest. The only thing I'm looking to buy on Monday morning are short ETFs because I think this market is on the precipice of a major break. More to come on that tomorrow with members. So the EDC has been pulling back. We're respecting the lower band of this triangle formation. Volume last week was below average, and it has been below average for several weeks, both to the upside and to the downside. So we'll continue to watch the EDC. If you don't like the volatility, trade the EEM if and when the time is right. Right now, the time is not right. We could scratch the itch if we wanted to using a stop right below last week's lows, and we may just do that. So members will discuss strategy on EDC tomorrow on the week ahead commentary. What else are we looking at? SPXS, or you could simply trade the XLP. These are the consumer staples. Now this is a monthly chart. The month isn't over. It's quite young. But you could see from last month we bottomed well off of the lows of the month. Same deal here so far this month. Now, very similar as to what we're seeing on the EDC, we're seeing here on the SPXS. We're seeing lower lows and lower highs on both the Stokes and the RSI. That's a concern. That must change. Let's go to the weekly chart, see how we closed out using the XLP. Now you can see that we rallied off the lows of the week. I don't think that these Stokes are done bottoming out yet. What we may get is a breakout above this upper band of resistance and then a pullback and a retest, and there will lie our opportunity to get long of the staples. Other than that, folks, there's not much that I want to buy here as a long on the market. I think that this market is under a tremendous amount of pressure. The headline risk is just amazing. It's highly unpredictable, and one thing that traders do not like is the lack of visibility. So if you are not a day trader, And most people are not, and most people who try fail. Don't get me wrong. I respect day trading. I am not good at it. I know my strengths and I know my weaknesses. So if you are day trading this market and you are losing money, you need to stop. Do not overtrade your account. I take zero pride in overtrading my account. Now, the knee-jerk reaction is after you take a loss is that you feel compelled to try to get back to even. That is a sucker's play. You need to fight that instinct, that intuition. It's bad. It's really bad. It's counterintuitive to think that you shouldn't try to, if you were, say, long of a stock, to then, after you stop out, get short of the stock, believing that that will be the direction in which it should trade. The problem is that you're in a meat grinder if you haven't broken down below critical support. That meat grinder will chew you up. Case in point, I went over this chart yesterday morning on Friday. Take a look at this chart here. We broke out on the 29th of March. The next day, we broke back down. We had a breakout point failure. We pulled back. Then on the 4th, we broke out again. Fast forward 2 days, we flash a bearish key reversal. And in all probability, if this market rolls over, so will Costco. This is a classic example of a meat grinder. You do not want to try to fight the markets using daily and intraday charts. You need to use the weekly chart. Stop with the daily charts. If you're not a day trader, stop with the intraday and daily charts. This is not the time to be playing around with daily charts. You need to take a look at the market from a higher level view. What is the directional move in which the market is making? Is it breaking down to new lower highs and lower lows? If yes, trade that direction. Do not hope when you should fear. Let's continue to use Costco as an example of when I would feel confident with buying Costco. Number one, the first thing that jumps out at me are your Stokes. The stochastics are trading down below the 50 level. I teach members this all the time. I pound the table on it all the time, and rarely am I proven inaccurate with regard to the stochastics. When you have both lines on Stokes trading down below the 50 level, rallies tend to fade. What happened? After we had a bullish key reversal the week of March the 26th, we failed to follow through. This situation here on the Stokes needs to get resolved. Either we need to sell off, trade down below the 20 level and form a double bottom setup like we did here, like we did here, like we did here, or we need to put in a higher low and ideally a double bottom setup. Now here is a higher low, not necessarily a double bottom setup, but a U-shaped recovery. Until we get that, Costco is off my list. I don't even want to talk about it until this situation here gets resolved. But prior to putting on the trade on Costco, I need to make sure that the S&P 500 is doing the same. I'm not going to bet that Costco is going to outperform by a wide margin the S&P 500. Why bother doing that? 85% of all stocks trade with their index. So the probability is against me. So folks, if you're hoping when you should fear, you need to develop a strategy and you need to revise that strategy constantly. And that's what we do here. On the weekends, the weekend commentary, and on the weekdays, market wrap. Even in the morning, stock charts today. Always be taking the pulse of the market. I digress. XLP, we're still watching. Shorts, BIDU, weekly chart, lower highs, lower lows on RSI, and Stokes did break down. The fast line broke down to a new lower low last week. We broke down on price. We attempted to try to recapture prior support. It is now resistance. We are trading down below the 50-period moving average. So members, we're going to be talking more about these Chinese stocks and what I believe to be a nice setup here to the short side. Google, weekly chart. We were in an uptrend. That uptrend is very close to being over. You can see that we broke down below this lower band of support after putting in a double top on price. We have both lines on Stokes trading down below the 50 level, and we are threatening to break down below 997. And you may be saying, you know, Bob, it broke down below 997, which just happens to mark the lows of February. That's why this number is so significant. And by you pointing that out, saying we did trade down below the February lows is a valid point. The reason why I don't put too much stock into it is that we did not close down below. It doesn't matter to me where stock trades intraday or intraweek. What matters is where it closes. So we did still close above support. So Google is looking good as a short, but we will approach it with a rules-based approach, meaning if it does this, we will then do that. All right, so we have a strategy formulated. I'll discuss it with members tomorrow on the week ahead commentary. The FXP, which puts you short of China. Now, I spent some time earlier in this commentary discussing the impact that the Chinese can have on the U.S. economy, and it's real. But have no doubt that the United States has a lot of power itself. You see, the Chinese have benefited from a world that has been unwilling to challenge its centrally planned government. Now that it is under pressure, let's see how they stand up. Their mettle is now being tested. They have gotten away with a tremendous amount in the South China Sea, bullying their neighbors, building the Spratly Islands. And you'll remember, even under George W. Bush, they knocked one of our spy planes out of the sky, intentionally. And one of the main reasons why you may see a shooting war, a hot war in the South China Sea is China's launch of the Petro Yuan. That is, folks, have little doubt, that is a torpedo in the water that is about to strike the hull of the United States right below the waterline. And while the Chinese may appear to be unbeatable in this trade war, it's not the truth. They're suffering. We're going to come back to this chart, and I'll show you the chart of the Shanghai Composite Index. And everybody needs to keep in mind that the Chinese stock market peaked out back here in June of 2015. Ever since then, they've been limping back up. It's like a dead cat bounce, but a massive one. And now they are rolling over yet again. Stokes are making lower highs, lower lows. This is a weekly chart. Let's go to a monthly chart. And you can see that on this monthly chart, we have broken down below the lower band of the rising uptrend channel. So getting back to our trade of shorting the Chinese markets, you could see that last week we broke out above the upper band of resistance, and most importantly, we closed there. Now, before we get all excited and say, you know what, it's time to short the Chinese market willy-nilly, we're going to just jump in on Monday morning, we're going to go shorting. No, not yet. Because believe it or not, we've been here before. We broke out the week before last, and then the following week, it broke back down again. So tomorrow with members, I'll be discussing our strategy for getting short of China using the FXP. We'll use a disciplined approach to shorting it, but simply because we have a weekly breakout is no reason to go jumping in and buying a ton of shares. Yet, anyway. All right, the other symbol that we're watching is the SPXS. This puts you short of the S&P 500. Now, while we are holding the breakout, we broke out 3 weeks ago, and we're holding the breakout. We did close off the highs of the week. That's a bit of a concern. So, members, what we'll be talking about on the week ahead commentary is the health of the S&P 500 on both a weekly, daily, and in all probability an intraday basis, because the S&P 500 is the major chart to watch. Because as goes the S&P 500, so goes the U.S. stock market. Have little doubt about that. The SPXS, this puts you short of the semis. The semis last week broke support. The SPXS rallied. They closed slightly off the highs of the week. They closed just shy of resistance. Volume last week was outstanding. RSI rising, Stokes rising. So there's little not to like here on the SPXS, but what I'd like to do tomorrow on the week ahead commentary with members is discuss the daily chart, as well as take a look, do a deep dive on the semiconductor sector as well. Because while the volume on the SPXS was great for the ETF, putting you short of the semis, we want to make sure that we have a corresponding volume bar to the downside for the SMH. Because remember, these leveraged ETFs are trading vehicles, and at times their volume could be skewed. So you always want to defer to the volume on the index that it is tracking or tracking inversely of. We're going to leave off here today with Alibaba weekly chart. This chart is under incredible pressure. RSI, lower highs, lower lows. Same deal here on Stokes. Both lines trading down below the neutral level on Stokes. And we broke down below critical support last week. And more importantly, we closed there. The only saving grace for this chart right now is the fact that you have the 50-period moving average in blue, which is rising, and it acted as support. Volume, very high to the downside. Ultimate oscillator, lower highs, lower lows. So members, more to come on Alibaba this coming week. And folks, if you're not currently a member, please sign up. Take advantage of the 14-day free trial offer. We'll open it up for the weekend. If you're watching this on YouTube, please subscribe to my channel. Give us a like. Click that bell. You can get notified of future videos. If you're watching us on the website, enter your email address. We hate spam too, and we'll send you out a few trade tutorials. And if you found us through Twitter, StockTwits, Seeking Alpha, follow me there. Everybody have a profitable trading week. Members, I will talk to you on the week ahead commentary. Be well.